Ray Dalio, legendary fund manager and one of the world's greatest investors, recently wrote an article about how investors must look to the future, not the recent past, when deciding how to invest. Let's discuss paradigm shifts. Roughly every 10 years, the world changes dramatically. If you can determine which shifts are about to happen, you can profit greatly. Or as Dalio puts it, identify the paradigm you're in, examine if and how it is unsustainable, and visualize how the paradigm shift will transpire when that which is unsustainable stops. There are always unsustainable forces that drive paradigms. For example, history has been littered with periods of low interest rates. Low interest rates means that it is cheap to borrow money. When money is cheap, businesses are able to take out loans and invest into their company. This paradigm, or period of time, is characterized by investments growing in value and economies thriving. During these periods, people extrapolate what they have witnessed in recent history to the future and make the assumption that this paradigm will continue forwards. However, it cannot last forever. Eventually, borrowers run out of borrowing capacity, lenders become squeezed, and credit problems emerge. The result is a reduction of lending and borrowing, which leads to falling asset prices and a slowing economy. As an investor, one of the biggest mistakes to make is to assume that these paradigms will continue endlessly. In 2008 and 2009, we lived through the Great Depression. The economy took a huge downturn and caught many investors off guard. Why? Because the preceding years had been so prosperous that many made the mistake of thinking that this would continue forever. Looking back through history, we can see this mistake has been made time and time again. Interestingly, paradigms typically last for approximately a decade. Nearing the end of each decade, we often see a big economic swing. In 2019, we could be coming to the end of our current paradigm. What should we expect over the next couple of years? To answer this, we must first consider what the main forces for our current paradigm have been since 2009. Two terms come to mind. Number one, low interest rates. Number two, quantitative easing. First up, low interest rates. Interest rates define how cheap it is for individuals and companies to borrow money in an economy. Let's say a company borrows £1 million at a 1% interest rate. Over 1 year, they'd be expected to repay £10,000 in interest. If, however, they borrowed £1 million at a 10% interest rate, they'd be expected to repay £100,000. When interest rates are low, the difference for the company is £90,000 extra in their pockets in this example. As a result, the company has more money to spend on growing their business. When companies are able to borrow money cheaply, i.e., when interest rates are low, this provides a stimulus effect on the economy. As a result, when economies are struggling, governments generally lower interest rates, making money cheaper to borrow and hopefully growing the economy. In 2009, economies worldwide were in a strong downward spiral. Governments globally stepped in and lowered interest rates to limit this effect. Number two, quantitative easing. Quantitative easing is a fancy way of saying printing money. Apparently, using the term printing money doesn't instill people with confidence. Quantitative easing involves central banks creating new money out of thin air, which is then used to purchase assets, typically government bonds, from businesses. As this occurs, there are two main effects. Number one, the price of government bonds increase due to higher demand. As their prices rise, government bonds become less attractive investments. Number two, businesses now have more money to spend. When they are deciding where to spend that money, they could purchase government bonds, which are typically the safest investment around, but the prices have already risen so much. Instead, they might look to more risky investments, which can offer higher returns. The result? A further increased stimulus for the economy. Is this period coming to an end? As interest rates are at global lows, many central banks can't drop them further. In fact, some countries, namely Switzerland, Denmark, Sweden, and Japan, already have negative interest rates. In the example we gave earlier, our business could borrow £1 million at a 1% interest rate. After a year, the business will owe £10,000 in interest plus the initial £1 million. If we now switch to a negative 1% interest rate and the business borrows £1 million again, they don't owe £10,000. This time, the lender owes them £10,000. That's right, the business is being paid to borrow money. If we jumped in a time machine, went back 20 years, and told an economist the negative interest rates would be a real thing, they would have likely laughed. This could be seen as an indication of an unsustainable force. How about quantitative easing? Quantitative easing, or money printing, has had a strong stimulative effect since 2009. However, it has had diminishing effects over time. Furthermore, attempts to employ quantitative tightening, the reverse of quantitative easing, have caused taper tantrums in the markets. What happens next? Monetary policy generally shifts back and forth between two modes. Number one, helping borrowers at the expense of lenders by keeping interest rates low. Or number two, helping lenders at the expense of borrowers by raising interest rates. By asking who the central bank needs to help the most and what tools they have at their disposal, we can determine what forces are likely to drive the next paradigm shift. For Ray Dalio, it seems obvious that they have to help borrowers relative to lenders. In normal economic times, this would mean lowering interest rates and employing increased quantitative easing. However, both of these have become less effective, offering diminished returns over time. What other policies are therefore likely? Dalio believes that the monetization of debt and currency depreciations will eventually pick up, which will reduce the value of money and real returns for lenders. This will test how far lenders will let central banks go in providing negative real returns before moving into other assets. In other words, by reducing the value of fiat currencies and making lending less and less attractive, investors may look to more risky investments, thus providing an economic stimulus. With this occurring, there will be greater internal conflicts between socialists and capitalists about how to divide the pie, and greater external conflicts, mostly between countries, about how to divide both the global economic pie and global influence. In such a world, storing one's money in cash and bonds will no longer be safe. The big question then is, which investments will perform well? According to Dalio, those that will likely do best will be those investments that do well when the value of money is being depreciated and domestic and international conflicts are significant, such as gold. Dalio adds, I believe that it will be both risk reducing and return enhancing to consider adding gold to one's portfolio. Within Dalio's extensive economic breakdown and his discussion of how the upcoming paradigm shift may look, he settles on the conclusion that the majority of traditional investments, such as stocks, bonds, and holding cash, look likely to have poor returns in the coming years. Instead, he highlights gold, an asset which has long been considered as a hedge against traditional markets. A hedge against traditional markets is an investment which generally moves in the opposite direction to those traditional markets, i.e., when markets are dropping, a hedge will generally grow in value, and vice versa. Looking back to the last Great Recession, we can see that the S&P 500, a measure of the US's stock market, lost nearly half of its value beginning in 2007 and bottoming out in 2009. During that same time period, gold held its value well, offering positive returns to investors. As the emergence of decentralized technology grows, cryptocurrencies such as Bitcoin have been thrust into the public eye. Due to its inherent decentralization and mathematically limited supply, Bitcoin cannot be influenced or printed by governments. With this, Bitcoin has been described by many as, like gold, a hedge against traditional markets. While Dalio's article doesn't directly mention Bitcoin, he does highlight market hedges. I, like many of you, believe that Bitcoin is gradually transitioning into this category of investments. Bullish signs. A word of warning for all Bitcoin holders out there, myself included. While Bitcoin is viewed by some as a hedge against traditional markets, it is still a very new asset. Therefore, Bitcoin isn't yet accepted as a hedge by all. Many still view it as only a speculative investment. Being too heavily invested into such a volatile asset would likely leave you overexposed in terms of risk. While the Bitcoin community often argue with gold fanatics, stating that Bitcoin is the new gold, investors do not have to choose between them. In fact, with gold's strong global acceptance as a good traditional market hedge, and Bitcoin only beginning to break out in this field, it would likely make more sense for investors to consider holding both as part of a well-diversified portfolio. If you've enjoyed this video and would like to see more content just like this, comment below with your suggestions on other topics, and remember to subscribe. Disclaimer: nothing in this video is intended as financial advice. While Ray Dalio is considered one of the greatest investors of all time, he is only human, and he will be wrong from time to time. Following his words on my own without carrying out thorough research, weighing up your risk tolerance, and making your own decisions would be incredibly foolish.